Okay, we have a article here that explains cocoa grinding estimates, and it basically is saying that there's going to be some demand destruction. So let's go to the article and let's look at the details of it, and then we offer some feedback in response to what exactly they are saying, because it might be a little bit convoluted for some, but let's just jump in and take it from there. So, with cocoa prices hovering over $8,000 a ton in New York, the long anticipated demand destruction for cocoa is finally approaching. New estimates indicate that global bean processing likely declined in the second quarter. So, according to 6 analysts and traders tracked by Bloomberg, second quarter global grindings, where cocoa transforms into butter and powder used in food products, likely fell from a year earlier. Estimates from European grindings likely fell 2% in the quarter, hitting lows not seen since early 2020. All of the analysts forecasted much larger declines in the second half of the year. So, the cheap stuff is beginning to drop off and the expensive stuff is coming in, said Jonathan Parkman, head of agricultural sales at broker Marex Group. Parkman said the worst of input inflation will affect the second half of this year. The grinding numbers are nowhere near the deterioration to end elevated cocoa prices, but the estimates suggest emerging demand destruction. We are more likely to see a significant change in the grind number in the second half of the year, said Darren Stetzel, Vice President of Soft Commodities for Asia at broker StoneX. Stetzel noted that the market has been forced to adapt to the scarcity of beans, which should alleviate some demand pressure. He pointed out that chocolate makers are increasingly using substitutes like palm oil. Grinding data from Europe is due on Thursday, and Asia and North America will report next week. Last month, the Kit Kat maker warned cocoa inflation will soon set candy bar prices higher. End of article. And that is an article that we covered recently on our channel here. So there's two things to take away from this report. Well, in addition to, of course, the prices, because the prices, as demonstrated here in this illustration, the prices have come down considerably since the market peak, which you could say occurred back around March. And then you can say there was a correction around May. And then most recently, just a month ago, let's say in the month of late May, early June, there was another peak around 10,000 a ton. And now it's around 8,000 a ton. And so the two lines that are extrapolated here are basically saying that there will be some price stabilization. There's been a floor, but there's price stabilizing. So that's simply just the cocoa futures. Now, when it's talking about the inputs, they're saying that the cheap stuff, meaning that cocoa that was most recently priced in at a cheaper amount, that is now coming to term. That is now run its course. So the new input that will be grounded and grind for butter and for powder, etc., to get the raw material that's the final input material will now be at the higher prices. So that's when things will kick in. And then the second part is also saying that there's not going to be the demand destruction. So again, it says the grinding numbers are nowhere near the deterioration to end elevated cocoa prices. Okay, but the estimates suggest emerging demand destruction. So there might be some demand destruction, but I find that hard to believe. Yes, there's substitutes in this marketplace as well, with something that we try to cover as frequently as possible for chalk and chalk alternatives, cocoa alternatives, more from the investment side versus the trading side. But it still seems that as the chart up here shows, and we can really just forget these surveys because these surveys don't really help too much. And it seems very much like there's not much variation here when we're talking about because there's not much band here. Everything is it's a tight band of expectations from the surveys. But what's most important are these charts here. It shows that there was even just 2 years ago, a very depressed price. Now there is a huge price, and now the market factors have to essentially incorporate and price that in. If the supply side is now at a higher price, meaning input materials, and then the demand is not really tapering off, of course you're going to stay at this new floor, which is the green line on this chart. So that's what we wanted to clarify for those that are maybe not too familiar with this commodity. There's a lot of moving pieces, of course. We like to focus on the upstream part, which is the farmers, and then the wholesalers, the exporters, the distributors, and then now the substitutes from the investing side. But the market is speaking for itself that it's been crazy. There might be weather affected, but I still believe it's demand affected. There's just so much. The demand is outstripping supply, and even for substitutes. And I think that is going to be the number one factor. The number two factor would be El Nino, La Nina. So we're going to leave it at that. I just wanted everybody to have a better insight into what we believe are the contributing factors to what we see here on this graph. Have a good day.